Imagine a flood so vast, so overwhelming, it's considered a 1 in 500 year event. That's what just happened along the Yellowstone River. A deluge of unprecedented rain and rapid snowmelt converged to create a flooding event of monumental proportions. Over 10,000 visitors to Yellowstone National Park were swiftly evacuated as the floodwaters surged. The park, one of America's most beloved natural treasures, had to close its entrances, an occurrence as rare as the flood itself. But why did this happen? Scientists point to climate change as a key factor. The frequency of extreme weather events is on the rise, and this flood is a stark reminder of the consequences. The Yellowstone River didn't just exceed its banks. At two key locations, the stream flow reached levels that define a 1 in 500 year flood. It's a sobering reality, but even in the face of adversity, there's resilience. The park is slowly reopening, starting with the South Loop, and Montana's Governor Greg Gianforte encourages visitors to return. While certain areas are accessible for day use only, the state's message is clear. Montana is open for business. As the park begins to reopen, the impact of this massive flood continues to reverberate, reminding us of the undeniable reality of climate change. In other news, the U.S. Air Force is aiming for the stars. But first, they need to get rid of some old weight. The Air Force is looking to shed its aging fleet as it prepares for the challenges of the future. Secretary of the Air Force Frank Kendall has thrown a spotlight on this issue, highlighting the need to retire older aircraft that may not be suitable for a potential conflict with nations like China. The Air Force is shifting its focus towards what it calls great power competition, which essentially means preparing for potential conflicts with other major global powers. This shift in priority has prompted a reevaluation of its aircraft inventory. In its fiscal year 2022 budget request, the Air Force proposed retiring over 200 aircraft, including some of the older models like A-10 Thunderbolt II attack aircraft, F-15C/D Eagles, and F/16C/D Fighting Falcons, just to name a few. However, this plan of action has not been without its hurdles. The Air Force has faced opposition from Congress, which has been unwilling to retire these outdated airframes. Lawmakers argue that these retirements could potentially limit the Air Force's access to advanced technologies that could effectively deter potential threats. But the Air Force is holding its ground. It argues that retiring these outdated aircraft would actually free up funds for new capabilities and prevent the need for costly repairs and maintenance. From their perspective, holding on to these older models not only jeopardizes national security interests, but also hinders the modernization efforts of the Air Force. So while the path ahead may not be without its obstacles, the U.S. Air Force remains steadfast in its commitment to modernization. They believe that in order to maintain their edge in the sky, they must first let go of the old to make way for the new. The path to modernization is not without its roadblocks, but the Air Force remains committed to maintaining its edge in the sky. For those of you with an eye on the investment world, here's something to consider: the Liberty All-Star Equity. This closed-end fund, trading under the NYSE ticker USA, has been making waves, but not necessarily for the right reasons. It's a unique beast, selecting 5 asset managers with different investment strategies. But this diversity hasn't translated into success. In fact, it's significantly underperformed compared to the S&P 500. One reason for this is its structural issue of distributing 10% of its net asset value quarterly, a policy that doesn't hinge on dividend income or capital gains. Now, in the world of investing, longevity can often be a good sign. But in this case, the long track record of the Liberty All-Star Equity, which dates back to 1986, raises some red flags. For one thing, its assets under management have rarely surpassed the $2 billion mark. Looking at the fund's financial statements, we see an increase in total shares, while earnings per share were lower than dividends per share in many years. This is a worrying sign, as it suggests the fund's distribution policy often results in returning capital to investors, thereby diluting performance. The portfolio of the Liberty All-Star Equity also leaves much to be desired. It has a low upside potential and negligible dividend yield, with a value-driven approach and a price-to-earnings growth ratio of 1. Unfortunately, the mix of value and growth strategies hasn't worked well under the fund's 10% distribution policy. All these factors have led analysts to rate the fund as a sell. It's a stark reminder that not all that glitters is gold in the investment world. In the world of investments, it's always important to do your homework. And in the case of the Liberty All-Star Equity, it might be wise to proceed with caution.